Hello and welcome to this week's edition of the Australian Market Digest. I'm Stephen Hogan, author of the Digest, guest expert on Sky Business Channel's Your Money, Your Call and Market Moves, as well as guest expert on CNBC's Cash Flow from Australia. Now for just some general housekeeping before we get started. When tuning into the Australian Market Digest each week, please remember the analysis in the Australian Market Digest, we have not taken into consideration your personal circumstances, objectives or needs. So please, when you do listen and tune into the Australian Market Digest each week, please make sure that before acting on any advice in the report that you do go out and seek professional advice. If you are looking for professional advice and you're not a client of ours already, please feel free to shoot me an email or give me a call or go to our website www.stephenhogan.com.au and we can have a chat in relation to becoming a client of ours. And just lastly, the opinions or views expressed in this report are the personal opinions of my own and do not represent the views of Novus Capital Limited. Okay, so let's take a look at how markets performed last week in Australia as well as overseas. We did have a public holiday last week on Monday, so it was a shortened week. And early in the piece, it looked like we were going to have another negative week here in Australia. However, Friday, the market posted its biggest gain in a single day so far for 2013. At the close, the benchmark XJO index was up 96 points or 2.04% to finish at 4791.8, and the broader All Ordinary Index was up 90.6 or 1.93% to close at 4,775.5. On Friday, almost all sectors ended higher. With the defensive healthcare stocks the exception there. The miners, who have done it pretty tough all year, they've slumped by 16.2% in 2013. However, on Friday they were the biggest contributors to the gains, up 2.3% as a sector. An increase in the iron ore price also boosted the big miners. BHP up 79 cents or 2.5%. to $32.91. Rio Tinto shot up by $2.41 or 4.6% to close at $53.98, and Fortescue Metals was up 5.4% to close at $3.34. Investors also piled money back into the high-yielding major banks. CBA was up $1.33, ANZ up 81 cents, and Westpac up 76 cents. The standout was National Australia Bank, NAB. That was up $1.01 or 3.56% to close out at $29.98, right near that $30 region. The best performer in the top 100 was Beach Energy. That closed up 7 cents or 6.3% to finish at $1.18. Before Friday's price action, the Australian market had slumped 10% from the recent highs, posting losses in 13 of 17 trading sessions, pretty much 4 weeks in a row there, sending it to its lowest level since mid-January. It really has been carnage on the Australian market the last couple of weeks. Not many chances to exit positions. It's just really fallen away very, very quickly and come as a pretty big surprise, I guess we can say. How not so much the declines. We did expect some sort of pullback in the market. I don't think anyone was expecting it to come back as hard as what it has, though, over the last couple of weeks. It did look for certain that we were going to have another down week last week, aside from Friday's price action. We ended up gaining 54 points for the week, or 1.1%. However, as I've just mentioned, for the month of June, we're still down pretty heavily, 2.7% or 134 points. When we look at overseas markets and how they've performed for the month so far in the week, the S&P 500 is down 4 points for the month, or 0.24%. Last week it was down 16.7 points, or 1%. The Dow Jones for the month is down 46 points. For the week, last week, it was down 178 points, or 1.1%. The Nikkei, which we seem to be following very, very closely at the moment, which has seen some big losses over the last couple of weeks, bigger than our own local market losses. So far for the month, they're down 1,088 points, or 7.89%. Last week, the Nikkei was down 191 points, or 1.48%. And lastly, the market that we follow as well, the Shanghai, for the month, they were down 138.6 points, or 6%. Last week, they were down 2.21%, or 48.9 points there. When we look at economic data being released this week, not too much that should affect markets. A lot of data coming out, but of high importance. There's not too much coming out. On Tuesday night, we have US CPI, which is pretty important, and then of course Thursday night, which I think will have significant importance, but isn't really in relation to economic data as such. We have Ben Bernanke speaking from a press conference, in Washington, and he'll be. I dare say there'll be some comments and talk of exactly the Fed's plan on winding back stimulus, and I think due to the fact the way that markets have reacted over the last couple of weeks globally to the news of the Fed winding back stimulus, we haven't seen too much of a pullback in the US, but globally markets have been sold off pretty heavily. So I think we can expect definitely expect some comments in relation to stimulus, and also there'll be a summary on economic conditions in the US, as well as of course the rate decision. So now let's look at the analysis for this week and let you know what we're looking at. Obviously. I've spoken about the banks in the morning summaries, as well as the market wraps. There's been some ad hoc comments there. I also mentioned that we should be overweight the banks at the moment, and they're pretty much a no-brainer investment here. So let's just take a look at the banks here at the moment and see if there's anything from a charting perspective that we can take a look at as well. Okay, so the first of the banks that I just want to take a look at here is ANZ. Looking at a weekly chart here at the moment, we can see that ANZ came down from the high of 32.09 more recently to the low of 26.35, with a correction of over $5, $5.74, which equals around about 17.8%. Fairly significant pullback there, and funny enough, if we just look at the trend line here, I'll just put this on the chart, go to the bottom of the candlestick there. I don't like to take into consideration the wicks. We can see there pretty obvious support levels. The market's found this trend line here and then rallied significantly up to that 32 level we just talked about, and then pulled back impulsively the last couple of weeks right back to that trend line, and then found support there right on that level. Pretty significant that it has done that, and as I talked about, I'd be buying. We've talked about the last week in the morning summaries and in the market afternoon wraps. That once we got down to those levels, that we'd definitely be stepping in and buying those, and I feel that investors should be overweight the banks here at the moment. Maybe just de-risking the portfolio a little bit, any riskier assets that you do have in the portfolios, maybe just selling those and adding some extra funds here to the banks at the moment. Looking at volume, just down here at the moment, I didn't see anything obviously apart from this week. Increases in volume. I really would have liked to have seen, if we look at the daily chart, and I'll just get rid of that trend line if it lets me. I really would have liked to have seen some volume in here at the low on Thursday and Friday's price action, these two bars here. I really would have liked to have seen some extra volume come in there and really support the market. Very well supported by price action, but just volumes pretty much remain consistent. I really would have liked to have seen some spikes in volume there. When we also look at how this decline has come down from a daily perspective, we can see here that it's a pretty pretty standard sort of 5-wave Elliott wave pattern down here. You can see from the high we have one impulsive wave down, two sort of a short rally here that didn't go back up and exceed the high. So a short rally, it was unable to continue to go higher, and then a third impulsive wave down, which was the longest wave. And then this consolidation here, wave 4, which is typical characteristics, and then the last sort of impulsive wave down here, which was wave 5, and wave 5 generally will equal wave 1 or extend to 1.6% of it. Roundabout figures there, same as wave 1 down, and then we've rallied from that point. So good signs there on ANZ that we have found the low, bouncing off that trend line, and then we've also got a 5-wave Elliott wave pattern down, also telling us that we've also found a low there in ANZ Bank. ANZ Bank, previous to that rally on Friday, around about Wednesday, Thursday's price action when we were down near the low, got close to a 10% gross yield on that stock. So it's no surprise that has been well supported. If you are buying this stock at the moment and you are overweight ANZ, either Thursday or Friday, just the potential upside here to go back to the recent highs. I spoke to investors last week. They were pretty 50-50 in opinions. That some were adamant that the banks won't go back to their recent highs, yet others were sure that will happen within the next 12 months. Personally, I think the banks will 100% be back up to these recent highs if we get one or two more interest rate cuts from the RBA over the next 12 months, as well as a change of government, as well as the Aussie dollar sort of stabilising around, hopefully around about that 90-cent level. We've heard that recently a lot of the selling has come from overseas investors because of the volatility in the Australian dollar. If we get a correction down to that 90-cent level, or even 85 cents if we go down as low as there, and we stabilise around these sort of levels between 85 and 95, and just sort of consistently stay within those levels, you'll find that overseas investors will come back into the market once the Aussie dollar stabilises. And that will bode well, obviously, for our market as well. And obviously, I've talked about low interest rate environments before on the Australian market and what that will mean. And look, the yield is very, very attractive there. It's a no-brainer here at the moment. That's the reason the banks led the recovery, the first recovery up from the lows, and they've been the strongest performers. You'll generally find now that the market finds a low around about this 4,700 level that I've talked about, the first place that investors will generally park their funds again once they've got a bit of, they're happy to get their money back into the market. The first place they'll go back to is obviously the banks, especially when they're gross yields of close to 10% here on ANZ, National Australia Bank. Westpac and CBA obviously just a little bit lower there. So let's just take a look. Let's take a look at Westpac. CBA. Let's just take a look at CBA on the daily chart. Similar sort of characteristics, an impulsive wave down and then rally, but CBA a little bit different to ANZ, did actually go to a new high, a marginal new high, which generally is something that that's why I've avoided CBA as being one of my high recommendations. I like ANZ and National Australia Bank. After that, Westpac and CBA. When a stock goes to a marginal new high, generally it will go to a marginal new low. So if we pan out here, where is the marginal new low? It's down here somewhere. So that's pretty scary sort of stuff there. And we do know that CBA, historically has traded on once it's reached PEs of 17, which it did when it got to around about that $74 level. It has been sold off pretty significantly. But look, I don't think we're going to see too much more of a correction here in CBA. This may possibly be a B wave up here, and you might get a C wave down to this $60 region. but there was nothing wrong with buying CBA, in my opinion, around about this $64 level. You also have the dividend coming on CBA before the other banks there as well, so that will probably more than likely be well supported going into the dividend. And you can see here Thursday's price action was positive. And then Friday, that day there was also very good. Once again, nothing much to talk about there on the from a volume perspective. Looking at the weekly, CBA's had such a significant run here, and just for mine, it does seem a little bit expensive at the moment. Despite if I'm bullish on the other banks, generally, you'd say you'd be bullish on CBA here as well. It's one of those things where, when a stock has so much market share, generally, there's only one way that it can it can go in relation to its market share, and its market share becomes very saturated. And I feel like that's the sort of scenario. Telstra is the perfect example there, where if you look a decade back, it had so much market share of home lines. It wasn't funny, and their service was poor. There was only one way for that stock to go, and that was backwards. And Telstra did at that stage, and slowly but surely it lost its market share to Vodafone and Optus. Recently, it has dealt with that and become a very good stock again, and it's in a position where it's actually taking a lot of that market share back again from things like Vodafone that has very poor reception in relation to mobiles, and Telstra is also leading the way in relation to mobile internet there as well. So Telstra's come a long way from where it was in that saturation situation. CBA for mine is going through something similar at the moment, where National Australia Bank is trying to really move into that small business market and doing a very good job of it. ANZ is moving more into that Asia, trying to expand through Asia and so forth, and Australia, and then Westpac obviously trying to take market share back from CBA there as well. So for mine, CBA, whilst it's a great stock to have in self-managed super funds, and I don't think you can go too wrong here at the moment buying it at $64. If you're bullish on the other banks, it's sort of a contradiction to be bearish on CBA. So I don't want to be too negative on the stock. It's just my least favourite here at the moment. Really prefer ANZ and National Australia Bank. If we look at National Australia Bank now, clear uptrend here at the moment. So, found a low here. We've got a higher low here, higher low, and then hopefully this is the next higher low here. You can see there that it's come back to this region. Generally, when you're looking at uptrends, you can break one swing high, but you can't break two. So you can see there the last swing high was this level here on the weekly. We broke through that. If we were to break this level here, then it would mean that the uptrend is pretty much over, in my opinion, and from a lot of technical analysis opinions. So it was very, very good to see CBA rally off that level. And yeah, look, not exact characteristics of a key reversal here on the weekly chart, but certainly very close to it. And volume, we had a little bit of a spike in volume on that fourth week down. By the looks of it, 1, 2, 3, 4, yeah, fourth week down. But yeah, I really would have liked to have seen volume come in here on the daily chart the last couple of days. But once again, I guess that's the main thing we need to be concerned about. Even though the fact that we have seen nice bounces here, you can see the typical 5-wave down, 1, 2, 3, impulsive. Generally the longest wave, or has to at least be the second longest wave in a 5-wave decline, and it's the longest here again. Fourth wave sort of consolidation and the last sort of wave down. So we can see the typical 5-wave decline like ANZ, and then a bounce here. Only thing to be concerned is that we haven't got volume to back it up. So that's just the main thing to look out for, and obviously volume is very, very important. however, once again, National Australia Bank made a high of 34.20 up here. The low was $28.11, a correction of around about $6 or 17.8%. When you've got that gross yield of just over, well, previous to the jump up on Friday, the gross yield was around about 9.2% on National Australia Bank. When you've got that yield backing you up, as well, and that's what the market's looking for at the moment. They're not looking for too much risk. They're looking for risk in the equity market, but looking for that really strong yield, that safer yield that they're not getting from term deposits or just sitting cash in the bank. And 10% over the year is pretty significant. And when you get a big 5-wave correction like this, and you get to buy a stock that's offering a 10% gross yield after an 18% correction. You can't go too wrong, buying it at those levels, in my opinion, and it's a no-brainer here at the moment. ANZ and National Australia Bank, in my opinion. Even if National Australia Bank was to go up here back to the previous high, even if you're buying it early this week, you're looking at making 15% capital growth plus the 10% yield there as well. If it doesn't get back up to the previous high within 12 months, there's nothing wrong with sitting on the banks here for the next 24 to 36 months. If they don't get up there within the next 3 years, I would be very, very surprised. I mean, they've come down this far in 4 weeks. You'd have to be a pretty pessimistic person to say that those stock prices aren't going to go back up and at least retest the previous highs. So you've got big gains in capital growth there, or potential gains, and then you've got the yield backing you up there as well. I've talked about phase 1 of bull markets, where the market has a need or necessity to move back into equity markets because they're not getting the returns that they require elsewhere. So they do look to the equity market, and the first place that they look is the high yielding assets, which have been the banks, why they've performed extremely well. As we go into phase 2 and phase 3 of the bull market, generally the beginning stages of phase 2, after you've had such a correction like we've had, very strong impulsive buying again into those previous assets that did very well, such as the banks, and then slowly but surely, as the market gains more confidence and as the economy improves, there's more of an appetite for risk assets, and that's where we'll see the market come back into those resource plays. But it's just a matter of how long that takes to happen, and how long we see, if we see better numbers coming out of China, and continued improvement in the US, and we stop getting the IMF downgrading global growth, then slowly but surely the market and possibly a change of government could be a good catalyst for more investor appetite in that resource sector there as well. But as of right now, I feel clients and investors out there should be overweight the banks. So we'll be, if we haven't already done that, we'll be looking, you should be looking to do that, or we'll be looking to do that for you, and get you get overweight the banks. Or if you've already got a portfolio there and you've got some extra funds sitting on the sideline, that's what you should be doing right now. Is if you don't, if you've got some resource stocks in your portfolio that are long-term investments, so you don't really want to lock in losses at the moment, but you've got another couple of $100,000 sitting on the sidelines or extra cash sitting on the sidelines, you should really be investing that in the banks at the moment. And what you'll find is those returns that you get from the banks will either offset or even outdo your losses in the resource space, and then eventually what will happen is your dividends will come in, the resource investment will improve, and your portfolio will be really kicking along here over the next couple of years, and people should see some really big gains here going into 2015, 2017 in their portfolios. So, I know the market is hard to look at the moment. I talk to a lot of people on a very regular basis, and there's still not a lot of confidence there in the market at the moment with retail investors, mums and dads. But in my opinion, the market coming down to this 4,700 level, it's almost a gift from God. It's giving you another chance to get into a market that probably, that recent run up to 5,200, above 5,200 there, it didn't look like that, we were going to get much of a correction. Thankfully, we've been given another chance to be able to get fresh funds into this market at a good level, 4,700 here at the moment. I'd be taking full advantage of that opportunity because, in my opinion, you're probably not going to see this again. We may have another small leg down here after a half decent rally. Like I talked about, we may have a B leg up and then a C wave down. But I wouldn't be taking my chances on another leg down. I'd be getting my money into the market and just being thankful that you're being given another opportunity to buy this market at really good levels, and especially the banks, which we're talking about today. National Australia Bank, ANZ, we've covered CBA. We'll just have a quick look at Westpac here. Similar sort of story on Westpac. Look at the correction in this one. A high of 34.68, a low of 27.32 here. A correction of $7.36 or 21% in Westpac. And then look at the bounce here. So, there's another one, gross yield of close to 9% when it was down here. And then you've also got the opportunity, if it was to go back to its recent highs, of capital growth of 21%. So, I guess I don't want to harp on it too much here, but the banks here are really no-brainers. We need to be overweight the banks in portfolios. And making sure that we're taking full advantage of this correction in their share prices, as well as the yield that's going to come over the next 12 months. And yeah, I guess that's all I've got for you this week. I just really wanted to drum that home, talking about the banks this week. To be honest with you, I probably could have thrown out 30 to 40 buys this week that I've seen on the market. That I think, from a long-term perspective, long-term investments are very, very good value down here at the moment. But I really just wanted to concentrate on the banks here because I really think they're no-brainer investments here at the moment. And they're the ones that I've talked about quite a lot recently. But, there's buys all over the market here at the moment. But I think these are, the banks are going to be probably the outperformers here when the market... Now that the market's had a large correction, and people will be looking for, the first place they'll look for is obviously the yield there again, and that's that's what we've seen on Thursday and Friday, with some appetite for the high-end miners. If you're really going to invest money in the market here at the moment, probably best off at this stage sticking to the banks or the high-end miners like BHP, Rio, because they're going to be the ones that are going to outperform. However, there is going to come a stage where this market will go from looking for safety to really looking for those risk assets again and looking for those 50%, 100% returns once there's a bit more confidence in the market. And I can guarantee you it will come. I think probably it's not going to come until after the election now. It's still going to be, the market's still going to be looking for safety. We then may get a change of government. Some better numbers come out of China. The Aussie dollar correction flow through into the economy, the interest rate cuts starting to flow through into the economy, and then late this year, early next year, I think the market will really start to look at risk again. The resource plays will start to do really well. I've talked about 2014 being a big year on the Australian market. And I talked a lot about last year and early this year that this year was going to be fairly uncertain in relation to how the market performed. We expected gains by the end of the year, but there were going to be not a lot of corrections along the way, but there were going to be hiccups along the way. However, we thought that 2014 is going to be the big year on the Australian market, and we're going to see a lot of gains there. And they're for the reasons that I've just talked about. Low interest rate environment, change of government, the Australian dollar. A correction in the Australian dollar, a 4% correction in the Australian dollar, is much like a 25-point basis cut coming into the Australian economy. So all these things flowing through into the economy, the market will start to look at taking risk on and so forth. Come 2014, when we start to see maybe some profit upgrades coming through from companies and outlook starting to look a little bit better, we'll start to see some really big gains in 2014. And probably the appetite at the moment is going to be the banks and the high end of the in the market, like the BHP and the Rios, that you'll probably see the best gains come from over the next couple of months here going into the end of the year. Okay, so just in conclusion, really overweight the banks here at the moment. The favoured is ANZ, National Australia Bank, closely followed by Westpac, and then CBA coming in last. And then if you're going to look for some resource plays, sticking to BHP and Rio, and then looking for risk assets coming into the end of the year. But we'll talk about them over the next couple of weeks, and we'll adjust to the market as it comes up. Okay, that's it for this week's edition of the Australian Market Digest. Thanks very much for tuning in, and we'll see you all next week. For information on our services, please go to our website, www.stephenhogan.com.au. Once you go to the website, you can go to the free portfolio review page. At that page, if you're not a client of ours already, we can provide you with a complimentary, no obligation, free financial portfolio review. Typically, we specialise in self-managed super funds. So if you've got a self-managed super fund out there, and you're worried if your portfolio is suitable to current market conditions, if you're taking too much risk, or if you'd like to evaluate your current investment strategy, or hear about the benefits of generating income from writing covered calls, as well as the benefits of using our services, please feel free to fill out that free portfolio review page. That will come through to me, and I'll give you a call, and we can discuss your portfolio there. There's also other pages on the website there that are of great benefit. If you go into the members area and you become a member of the website, you can see the model portfolio that we do run. There's the press room, which has some of my appearances on Sky Business Channel as well as CNBC. And we also have a blog page there as well, where you can request certain stocks to be included in the Australian Market Digest, as well as amongst other things that we comment on in the morning summary and the market wrap. Okay, so we'll see you all next week, and thanks for listening.